recording this. Good morning, everybody. Hope everybody is having a good morning. We're going to be having a class today with Radlam with DRMC. He's going to touch base on Helocs and also standalone second TDs. So I'll give it over to Radlam so he can present his class.
Okay, wonderful. Thank you so much.
Yeah.
Hi, good morning, Peter. Good morning, everybody. Okay, just share the screen. Okay.
Okay, minimize this one.
You good?
Yeah.
You good?
Okay. Okay, awesome.
All right, awesome. Thank you so much for everybody for attending. I do have my colleague here, Petra, here
Hello.
with us. But so today, yes, today we are gonna do I guess like a presentation on HELOC and second liens, basically a second mortgage on the property, and you know, the HELOCs and second liens are you know, in a way to get more well, I guess in a way they use as tools for you know, prospective home buyers and also existing homeowners, right? For homeowners, you know, the HELOCs and second lien could be used as could be used or tapped into as down payments for various things. So we're gonna go over those things, and also for maybe for buyers, right? For a new buyer, they could use the HELOC or second lien as a way to reduce their down payment requirement, and also for removing the PMI.
And another thing is just existing homeowners, just having it as a reserve. That sense of security that, you know,
Exactly,
in any given situation, funds are there, and
right.
there's some really great benefits of the HELOC that we're gonna go over, but you know I have one, and we're always trying to make sure that, you know, and then again, any problem we have as reserves
For
on those
emergencies,
unexpected
exactly.
expenses, definitely.
Yep. So yeah, so I guess we'll start the presentations and just maybe go over the details of each type of these programs. So let me see. So again, so currently in the current market environment with high interest rate, you know, high inflations, high home prices, I guess many homeowners and investors and prospective home buyers are you know, feeling a little bit insecure and maybe are not sure what to do. So again, it's I guess it's up to us as real estate agents and you know, loan officers, lenders, to educate our customers and you know, provide them with the most accurate information and to allow them to make informed decision for themselves. Obviously, we don't want to push them to do anything, but I believe, you know, giving them sufficient information will help them do a better job, you know, deciding the best course of action for themselves. So according to the Federal Reserve's most recent data, the total U.S. home equity has reached a record $27.8 trillion. And I cannot even like wrap my brain around that number. So for sure, I mean, you know, I guess it's safe to say this is a huge amount of equity that could be tapped into.
It is a shocking number, but again, that's how accessible these products are.
Right, absolutely. I mean, that's I guess a lot of people don't think about, you know, utilizing their home equity. So currently, according to Freddie Mac's, which is the U.S. Entity that purchase mortgage loans like Fannie Mae, and they do like a weekly survey of with lenders, and so they're on July 21st, the average, I guess, 30 years, was 5.54, 50-year 4.75, and 5-year about 4.31. So the rates are obviously have been like in the mid to high fives in the last couple of months, maybe even 6. So the question, I guess, again, comes back to or down to what should a homeowner, investor, or prospective home buyer do, in this type of environment. And we want to suggest that maybe they might want to look into, tapping into a HELOC or a second mortgage. So typically a second mortgage is basically a subordinate mortgage to the original mortgage. So typically what that means is a homeowner already has a mortgage, a first lien, and basically second mortgage is like additional loan that they put on the mortgage. I mean the property. So in a refinance situation, the second mortgage takes a second position to the first or original or existing mortgage. In a purchase situation, a borrower would acquire 2 loans in a sense. One is the original amount, which is usually 80% of the purchase price. And the second, could vary from 5 to maybe in some 5 to I would say in some cases like maybe 15, right? 80, 15 %. So it depends on their qualifications. And usually the second loan amount is almost always smaller than the first one, the first lien. So
So there are various types of second mortgages. One be the piggyback. The other one is the standalone, the very popular HELOC, and the home equity loan, which is very similar to the HELOC. So the piggyback loan is a type of loan that is piggybacks on the first loan, the first mortgage being 80%, and the piggyback loan could be 10%, where the buyer comes in with the additional 10%, making that.
Right, exactly. Like we mentioned earlier. So usually they want to obviously to make sure the first loan amount doesn't exceed 80% of the purchase price, basically to avoid the PMI, right? And then the second loan, which could be a HELOC or a second fixed rate loan, could be either 10% or sometimes could be even like 15%. And then the down payment amount would be in this case right here, the down payment would be 10%, right? So you have 80 the first loan, the second loan is the 10% of the purchase price, and then the down payment amount would be 10%. So that would be total equal to the purchase price. So again, the main idea is with the second lien, the borrower doesn't have to come up with as much down payment, and also they will be able to eliminate the PMI. So
various ways of structuring creatively that that down payment and getting rid of that PMI.
Yeah.
The standalone and the HELOC is basically mortgage home equity line of credit, which functions just like a line of credit, like a credit card, mind you.
Or it could be a second lien also.
It could be the second lien.
The reason why they call it is known as a standalone HELOC or mortgage is because it's usually taking out after the original loan was already taken out. So that's why it was not taking out at the same time of the original loan.
So it doesn't impact your original
Exactly.
mortgage.
Exactly.
Your original mortgage stays as is, and the HELOC takes its own entity.
Yep.
So again, it's like a HELOC is like a line of credit, and you draw from your home equity. So you know, sometimes an appraisal is required to see, making sure that the equity is there, and it is tied to the prime rate. So many reasons why you want to take out a HELOC is to consolidate debt, college tuition, maybe you want to take that expensive vacation that you haven't taken in a while. Maybe very popular home improvements. That's huge. You know, you want to upgrade the kitchen, the bathroom, you want to do a new roof. HELOCs are a great access for that money if your equity is there. And of course, if you want to have some money there for additional investments, buy another piece of property, that will be another great use of your HELOC. And I've said it before, just to have that those funds as reserves, knowing that in any given situation, any unforeseen expenses might show up, you have those funds available, and you are not paying anything on this HELOC unless, of course, you draw that money. So some of the advantages of a HELOC is that, again, you are only paying interest on that money that you're borrowing. You know, that, and you'll see later, becomes also a disadvantage because you don't have this big payment to make on your HELOC, but because you're only paying towards interest. But at some point, if you want to see that principal go down, you need to start making payments towards your principal, right? And you can also, another advantage is that you can withdraw HELOC funds anytime throughout the drawing period, as long as you continue, of course, making your interest payments. And of course, you can draw as little or as much as you want from your HELOC. I know for some programs, they have like an initial draw. They have a limit on the initial draw, but for the most part, as you need, you draw, and depending on how much you draw, that's going to be your payment based on. Your existing mortgage, again, is not impacted by the HELOC. It doesn't change. It stays as it is. So that's something that, you know, it gives us a peace of mind that we know that our existing mortgage is put.
Especially in situations, right, where the existing mortgage has a lower rate, and obviously the homeowner doesn't want to refinance and you know, get a higher rate in this environment. So this HELOC would be a, you know, ideal kind of type of or way to tap into the equity.
Definitely. Some of the, you know, I guess disadvantages, for lack of a better term, is that you'll have another monthly payment with your HELOC. Again, just interest is a requirement. Having that money in the bank, I know it's really good to have those reserves, but it could be really tempting, right? Because wow, I have this much money in the bank that I can go do what I want to do, right? So just being mindful of that. And again, the interest rate is the prime rate. So, you know, it could go up, it could go down, surprisingly, right? But that's something that you need to be mindful as well with the HELOC, that those rates is not fixed. It's not a fixed rate. So
yeah, it could adjustable, I guess, anytime, basically, just based on the terms provided by the bank, or could be based on the prime rate. You know, depends where the prime rate goes.
And so with Diamond Residential, we do have the options of having structured your HELOC with the fixed payment of
like principal interest.
principal and interest.
Yeah.
Mhm.
So yeah, well, so basically, as we all know, like the current prime rate is 4.75, and the Fed has started their July meetings today and tomorrow. So tomorrow they're gonna make an announcement on what. I mean, it's almost like a guarantee they will raise the benchmark rate, which of course will basically affect the prime rate. So if they raise the the rate by 0.75% to 1%, we are going to be seeing 5 and a 3/4 to maybe maybe 5.5 to 5 and 3/4 by tomorrow. After that meeting, after the announcement. So I think that a lot of people might be interested in knowing what's like what type of HELOC rates we offer. So this is actually directly from one of our investors. And like I alluded to, or Petra alluded to earlier, I mean, with this investor, they do offer like principal and interest type of payment. But traditionally with most banks, they offer like interest only, right? So in this case, the rate would be right here is the prime rate, which is 4.75. But because of the customers like good FICO score, they actually give a rebate of 0.5%. So technically the borrower would end up with about 4.25 for this for whatever loan amount they took out. So here they do have a maximum loan to value, combined loan to value of 80%. What that means is your original, your first lien and the HELOC combined, cannot exceed 80% of the property value. And here, as you go down, based on the FICO score, the final rate actually, goes up a little bit, as your FICO score gets lower.
Yeah, you get hit with a.
Right. So, and traditionally the HELOC, the interest-only HELOCs, can only be used on primary home, owner occupied property. But now we have more and more investors who are offering HELOC on second home and also investment property. And usually, traditionally, the interest-only is basically packaged like this. You have 10 years to draw the amount of your HELOC loan. And then you have 24 months, like basically 20 years to make payment back on the loan. And with this investor we have here is about 640 FICO score minimum. And the other program this investor offers is also the principal and interest. So it's not just interest. So they actually allow the borrower to do like combined principal interest payment, and their terms here is the maximum is 180 months, which is 15 years, and it could be on a second home or investment property, and of course also on primary home as well. As you can see here, the rates are higher, for this program. For a fixed rate program. So here they also use the prime rate plus the so-called margin, which is in this case right here, the prime rate is 4.75, and then add margin, which is their profit, basically margin the profit to the bank, to the investor. So here you get like 4.75 plus 0.5%, that's equal to 5.25. So that's pretty much the best rate from this investor. And then so that's for a primary home. And if you go to a second home, then you can see here, right, the rates are getting higher. And they also offer investment property HELOC.
The LTV, right, is less.
Right. and so the rates are getting higher, but also the maximum loan to value, right? Combined loan to values are also getting lower. With the primary home, you could go up to a combined, LTV up to 90%, and then or even with the second home, but with an investment property, maximum 70%. I'm sorry.
But no, I'm just saying it's a great option to know that if you have an investment property, if you don't want to touch your primary residence, that's an option too.
Mhm.
And also one thing to keep in mind is that we have various investors. So we will sit there and look at which program fits you best. Because, maybe this investor is not gonna, it's not the best option. We have other investors with the Heloc program.
Right.
Second.
So we do. I believe we have, beside this investor, we also have 2 other investors offering Heloc. So with various degrees of requirements, interest rates, and I guess qualification, requirements.
Mhm.
So at the other, so we finished kind of discussing HELOC, and now we're going to go into like home equity loan. So home equity loans are referred to by different names, like a second mortgage, equity loan, or home equity installment loan. And essentially is like an equity mortgage that is giving against your property. So it's just like a HELOC, just like a first lien. This type of loan is fixed rate and pay in lump sum. So unlike a HELOC, right, where you could draw, right, you just use as much as or as little as you need. But with this type of loan, basically you take out a second mortgage or loan in a lump sum situation, kind of payment. So there's no drawing or anything like that. You just take it out and you have a fixed rate second mortgage. And this is just a little comparison. I actually got, just got this from online, but I think it has illustrated, very well what's the difference between like a HELOC and the second lien. So I mean, just go over the here. I mean, so with a HELOC, right, functions like a credit card with limit basically on the based on the home equity, and a second mortgage, functions just like a mortgage with a low amount, also based on the home equity. And HELOC funds could be, drawn as much or as little as you need, but with a second mortgage, basically again is a lump sum situation. You basically apply for a certain amount, then that's what you get at closing.
And that's such an important point, because if you are having, if you're pulling out a HELOC because you want to do renovations, and renovations are going to take 6 months, however long that takes. I don't know, right now with the current situation, and it's so hard to get a contractor to do any kind of building. With the second mortgage, you start paying on it the minute you get your money, which is right away. You got the monthly payment. With the HELOC, if you're only using $20,000, then that's all you're paying on, those $20,000. So that's something I think for a lot of borrowers, that's an important piece of information to really keep in mind.
Right. I guess also, if you are to take like a small amount each time, then probably it's more advantageous to get a HELOC, right? Because then it's okay to have a variable adjustable rate, and then it also allows you more flexible payment, right? Just interest on the amount you take out. But if you consider to let's say trying to do like a renovation project, you require 100,000, 200,000 to do it, you probably don't want to have an adjustable rate kind of loan floating around. So if it makes sense, you probably would want to get a fixed rate loan. And as we know, I mean, in this environment, I mean, every couple of months, I mean, the rate could go up. So So, and we, obviously it's, we cannot predict, when might the rates, come down again. So again, it really varies based on each person's, situation.
Circumstances,
Yeah.
right? Well, that's the beauty of this, is that we have options, and, plenty options.
Right. And again, we touch on a couple of these items right here, with HELOC prepay, payment will be interest only. It's great for recurring expenses like, tuition, medical bills, and home improvements. And again, probably in smaller amounts. So versus a second mortgage where you probably want to have a, fixed principal and interest payment, because you want to avoid, the rates going up. So this, would be, again, applies to major home renovations, right? And also maybe consolidating your debt.
Mhm.
So when you are, maybe you have a lot of, I mean, in a situation where you have credit card, debts, where we know the rates are in, in the high teens to 20s, so definitely it's something that varies from each person to each, to person. And so we do have a rate sheet for the second mortgage here, also from the same investor. Here, the rates are actually not that bad. I mean, we're looking at about 5% to maybe 5.5. Depends on the loan to value. Depends how much you're borrowing, and also it depends on your FICO score. So here you see the rate for primary home, right? Based on LTV, based on the FICO score, and the only thing is with this investor, the term here is quite short. So it's a 5-year kind of term. So if you in a situation, if you take out like a high loan amount, maybe this is you might want to look for something with a longer term, so you end up with a maybe a more comfortable monthly payments. And so with if you do the if you take out like a second on a second home, then the rate would be about 1% higher. And also with an investment property is also about 1% higher than a primary home. And let me see, minimum usually, so they do have their range in terms of the loan amount. So here you based on your FICO score, what's the maximum and minimum loan amount you could apply for. And these are just basically these are actually more for the loan officer to look at when we try to quote a rate to our customer. So that's that's really the rate, and whatever you see here.
Different scenarios.
Yeah, exactly. And again, they are still quite comfortable in terms of quite doable, I should say, maybe. I mean, the rates are not exactly anywhere close to a hard money kind of situations.
Definitely.
Yeah, but again, the other thing to remember is the second lien HELOC are usually higher than a prime than your conventional full doc type of loan. So usually you get better rate on your first lien.
This type of for the HELOC, for instance, they're also they tend to process a lot quicker too.
Mm-hmm.
Within, I don't know, 2-3 weeks,
Right.
you have the funds.
So here just some final thoughts. Just our thoughts, I guess. So how do you utilize, I guess, HELOCs and second lien, right? you know, for sellers who want to fetch better prices for their home, you know, before listing the property, and let's say they don't have the funds to renovate the property, so they could potentially tap into the home's HELOC, or, you know, equity loan to pay for the improvement. And again, it depends on how they would like to structure the loan. I mean, you know, to avoid to give them the lowest cost possible, right? Because if they intend to sell the property, so obviously we want to make sure they don't get a loan that potentially could reduce their overall profit.
And for a buyer, this allows them to reduce their down payment that they need to come in with if they tap onto a second mortgage or a HELOC.
Right. And also for for investors, obviously, right? That this is also a good way to get additional fund for down payments and to make to buy additional properties. So obviously, HELOCs and second liens are not always perfect or suitable for all customers. So it really depends on that situation. And in some cases, maybe we might need to look at other programs. For example, like right now, with Diamond and maybe quite a lot of lenders out there, we do offer this so-called DSCR program, which is an investor cash flow program. And basically, we could actually do a cash out refinance on an investment property, basically just using an appraisal, practically it's an appraisal and credit report. And even in purchase situations, under the DSCR program, they usually require 30% down, and then also an appraisal and credit report, and we will be able to do a loan for them. So but again, HELOCs and second mortgage are some tools that maybe a lot of real estate agents and maybe prospective buyers, investors, and also sellers are not maybe thinking about. So as I guess as agents, we want to make sure we educate them and give them as much information about these products as possible. So that could help them, and that could help you, with your transaction volume. So I think that's all we have. I mean, in terms of the presentations, and if there's any questions, feel free to let me check with the chat.
Nothing there.
Yeah, we don't have any question on the Zoom chat box.
Relam,
Yes.
the HELOC loans are mostly a variable adjustable rate.
Exactly. We have seen most of lenders, especially the bigger banks, right? Your Chase, your B of A, Citi, they usually offer HELOC, interest only HELOC.
I see.
Right.
Now, what about if you want to refinance? You have a lot of equity in your commercial properties. You want to refinance and get some cash out. Do you have a fixed rate program?
Now, Peter, do you mean like in a residential, or you talk about commercial?
Commercial.
Oh,
Like the
commercial.
apartment complex, like.
Okay.
Yeah.
Like
that.
We don't do kind of commercial loan, but last week we had our commercial expert like doing the presentation, like Merle Clocky.
Yeah.
So he would be able to do that.
Okay, so is this going to be fixed rate?
Yes. So exactly. It's going to be the term is usually 25 years with fixed rate.
Oh, that's good.
Yes.
That's good.
So and we basically send all of our commercial transactions to Merle Clocky with from Anthem Capital Solutions.
Yeah.
I'm sorry, Inc. I think. yeah, I mean, if you have any scenarios, you know, we'll be more than happy to help you, you know, kind of work that out with Merle.
That's good. That's
Yeah.
good. And last questions. For you know, if you have a stocks and you want to use the stock as collaterals, I guess you don't do that, right? I mean,
Without selling the stocks, right?
right.
Let me see.
I haven't had a
Yeah,
scenario.
we haven't had a scenario where, I mean, stocks obviously, in a like conventional loan situations, or even on a lot of the programs we offer. So stocks, bonds, retirement accounts could be used as reserves.
I see.
So like when you have reserve situations, right, you need your 6 months, 12 months, or sometimes 24 months.
Mhm.
Obviously, we could use stocks and retirement account, investment accounts as for reserve, but not to I guess to take out cash.
I see.
Right, right.
Well, you know, I have a stock account in TD Ameritrade,
Okay,
and I can use my stock as a collateral,
okay,
and take out the cash for 3%.
for 3%. Okay,
Yeah,
well, through your own bank, right?
yeah, through the owned brokerage house, the TD Ameritrade.
I see, I see. Yes,
So that's much cheaper than you know, like
right, right.
the conventional
Yes, yes,
loans,
exactly.
and yeah.
Obviously, it sounds like you know you have an account with them. You're a existing customer, and
Yeah, it's like a margin account, you know. Of
right.
course, you cannot take out more than 50% of your stocks, so
I see, I see.
you know. And then anytime that the stock price fluctuates, you have to maintain the margin account.
Oh, okay. That's almost
Yeah,
like a
so
right, like a trading account where they do have that type of option, I guess, option
Right, right.
trading kind of situation.
so you don't have a program like that, huh?
No, we don't. We mainly do residential. I mean, so basically real estate kind of
Investment.
backed mortgages.
Yeah, that's how some of the people want to get the cash and to do some investment properties purchase.
Right, right.
Yeah,
So have you seen a lot of maybe people doing that?
yeah. Some
your
of my
service?
friends are doing that,
Oh,
but
really?
they don't want to. You know, they have a lot of equity in their stocks. They don't want
Right.
to sell the stock because if they sell their stock, there will be a lot of capital gains. You know,
Right, right.
and so they maintain that the stocks in the account, and then just you know, draw out some cash for their daily use. You know,
Mm-hmm.
I'm sure there's a lot of those people like Elon Musk and you know, Jeff Bezos. They're doing that so that they can
That's what I
uh,
heard
yeah,
exactly.
that they'll avoid the paying the you know,
Taxes.
income taxes
Right,
and the capital
right.
gains.
But it seems like, you know, with the reason, you know, stock kind of, you know, prices coming down and stuff like that, I guess maybe
Yeah, that's a
that-
danger. You have
yeah,
to
that could be a
maintain
situation
the
where
margin.
you may have to add money back to
Yeah,
the
yeah,
account, right?
exactly. Yeah,
Right.
that's a pitfall. Yeah, right.
Wow.
Exactly.
Well, Peter, maybe you could maybe teach a class for us on that type of I guess you know, strategy. That would be good to know too.
Mm.
But okay. Well, thank you so much, Peter, for the question.
Okay,
So
thank you.
yeah. So if there's no other questions, I guess we'll just call it you know I guess yeah, end our presentation, and again, just feel free to reach out to us, you know, with any questions on any specific scenario. Thank you so much, everybody.
Okay, bye-bye.
Bye bye. Thank you.
Bye.
Yeah.
Stop recording.